8. Group retirement and investment plans. The previous chapters in this manual have focused on investing products and plans for a single client, or a client that is a couple, and the role of the life insurance agent working with such individuals. In this chapter, the focus changes. The agent now becomes a service provider to a group sponsor or administrator, and it is the group sponsor or administrator that is the client. The agent works with that client to achieve its objectives with the group it represents. The group itself may be as small as a few people or number in the thousands. The group sponsor or administrator may have sought the expertise of the agent for other insurance products, such as group life or accident and sickness coverage. However, when the objective is savings and investment, typically for retirement income, the sponsor or its administrator then seeks the agent's recommendation for an appropriate plan. The sponsor who offers such a plan is making a commitment to the group members, and this commitment cannot be undertaken lightly. There are both considerable financial obligations for the sponsor and administrative costs incurred when a group plan is offered. The sponsor's rewards are the appreciation of the group members for the benefit the plan provides and the loyalty the plan engenders. This helps the employer retain its employees and avoid the expense of higher employee turnover. The plan may also enable the sponsor to attract employees. In order to provide sound advice to a sponsor or administrator, the agent must be familiar with many aspects of group plans, including Black small square group structure. Black small square plans available, including the client's existing plan, if applicable. Black small square investment options. Black small square recommendation process. Black small square group documents. Black small square service requirements. Black small square claims process. 8.1 Group plan structure. A group plan is comprised of its sponsor, its administrator, its members, and its insurer. The agent must be aware of the rights and responsibilities of each to ensure he provides appropriate service. Segregated funds and annuities. Chapter 8 Group retirement and investment plans. 223. 8.1.1 Group plan sponsor. A group plan is established and registered by its sponsor, usually an employer, with Canada Revenue Agency (CRA) and the provincial authorities concerned when it is a registered pension plan (RPP). It is subject to the requirements specified in applicable provincial pension benefits legislation. This includes compliance with filing certain reports, the possible need for an auditor's report, actuarial reports, and other reports as required by the jurisdiction in which the group plan is registered. Alternatively, some group pension plans are federally regulated and are not subject to provincial legislation. They are provided to employees who work in an industry that is federally regulated, such as banking. Registration with CRA ensures that the annual maximum registered retirement savings plan (RRSP) contribution limit is not exceeded, since registered pension plan (RPP) contributions reduce the amount that can be contributed to an RRSP. 8.1.1.1 Role of plan sponsor. The sponsor's role in providing the plan to its group members is to Black small square design the pension plan according to its needs, yet within the sponsor's financial limitations. Black small square set the benefit structure for members. Black small square establish, amend, or terminate the plan. Black small square ensure compliance with regulatory requirements for reporting. Black small square address funding shortfalls or surpluses. Final decisions about a group plan will be guided by the administrator and the life insurance agent, but are, in the end, the responsibility of the sponsor. 8.1.1.2 Funding commitment by plan sponsor. A sponsor takes on the financial commitment to fund the group plan as a joint contributor with the group members, or a loan on behalf of the group members. Black small square when the sponsor and the group member both contribute to a plan, it is said to have contributory funding. Defined benefit pension plans, DBPPs, defined contribution pension plans, DCPPs, group registered retirement savings plans, GRRSPs, and pooled registered pension plans, PRPPs, may all be contributory. Black small square when the sponsor alone contributes to a plan, the plan is non-contributory. A deferred profit sharing plan, DPSP, is non-contributory. Other plans may also be non-contributory if the sponsor makes the decision to forego employee contributions. When a plan has contributory funding, group member contributions are made through payroll deduction. Therefore, the contribution is made before take-home pay is received. Contributory plans may see the sponsor offer a matching formula, in which the sponsor bases its contribution on the one made by the group member. The sponsor can match 100% of the member's contribution, in other words a dollar-for-dollar contribution, or it can be a different percentage. The matching formula can be structured to increase over time. In this case, the matching contribution increases the longer the employee works for the employer. This can decrease employee turnover and employee loyalty is rewarded. Reward employees based on their value to the sponsor. In this case, the matching contribution can vary for different categories of employees. Therefore, the most valuable employees are more highly rewarded for their service. Create loyalty. The matching contribution may apply after an employee has worked through a defined waiting period. This helps to retain employees and discourage new hires from seeking other employment opportunities. Matching contributions can be changed or stopped at any time, if they are not a condition of an employment contract or collective bargaining agreement. The vesting provisions of a plan also impact funding requirements for the sponsor. Vesting describes who owns the sponsor's contributions to an employee's plan. During a period of time called the vesting period, an employee who changes jobs does not retain the sponsor contributions to his group plan. The employee retains only the contributions he made. However, at the end of the vesting period, the sponsor contributions become the property of the employee. In some cases, vesting is immediate and the employee retains both his and his employer's contributions when he leaves. A shorter vesting period is more expensive for the plan sponsor because his contributions could leave with the departing employee after the briefer period of time. Each jurisdiction establishes its own vesting period. 2 years is frequently considered typical, but vesting may be immediate or as long as 3 years. 8.1.2 Group Pension Plan Administrator. The group pension plan sponsor appoints the person or entity that is plan administrator. In Quebec, for example, group plans containing more than 25 members must be administered by a pension committee. In many plans, the sponsor is also the administrator. When the employer acts as the plan administrator, it must take into account the best interests of the plan's beneficiaries and not act solely in its own best interests. The pension plan administrator has financial and administrative functions. Those functions are performed by resources in the organization, such as human resources, or accounting, or a third party. When a third party is used, it is typically a firm that specializes in employee benefits and services. The agent works closely with the administrator throughout the entire process: proposal, recommendation, implementation, and follow-up. For a DCPP, the role of administrator may be assumed by the plan sponsor, a board of trustees, a financial institution, for a simplified pension plan, or a pension committee as defined by Pension Benefits Standards Legislation. 35. 8.1.2.1 Role of Group Pension Plan Administrator. The administrator is responsible for overall administration of the pension plan, including black small square management of the pension plan, black small square establishing a written statement of investment policy, black small square investing the fund assets in accordance with that policy, black small square creating and distributing other plan documents, black small square acting in accordance with applicable legislation. The foremost task of the administrator is to administer the plan in accordance with the act that governs the plan and its regulations. The administrator has a fiduciary duty to plan members. To fulfill that duty, he must act honestly, in good faith, and in the best interests of members, former members, and others involved in the plan. The administrator must also use the care, diligence, and skill that a cautious person would exercise when dealing with the property of another person. The administrator knows the size and composition of the group and its needs. He is involved with the employer's payroll department in order to make any deductions required for the group pension plan by its members. He also describes the benefits of the group pension plan to job applicants and reinforces those benefits to members of the group. The administrator enrolls new members and withdraws members who quit the company or retire. He is also the person group members can turn to for information, to initiate claims or to process withdrawals when he is changing jobs or retiring or when changes are required. The administrator is also responsible for black small square measuring employee satisfaction with the plan, black small square monitoring industry trends, governance guidelines, and legislative changes to keep the sponsor apprised of new developments, black small square suggesting potential plan and investment recommendations, black small square assisting with plan sponsor governance activities, black small square reporting to the sponsor. 8.1.2.2 Data provided by Group Pension Plan Administrator. The administrator provides the data about the composition of the group to the agent to enable an application to be completed. He has access to the records of all members and is, thus, privy to sensitive financial details. This information is protected by privacy legislation and must be kept highly secure. The group plan administrator ensures all the necessary information is provided to group members about the plan and their membership in the plan through the pension statement regularly provided to them. The statement details can include black small square type of plan, black small square amount deposited to the plan, black small square accumulated earnings, black small square account balance of the member, black small square investment allocation, black small square net return on the account for the period covered by the statement, black small square current years of service. Segregated Funds and Annuities Chapter 8 Group Retirement and Investment Plans 227. Black small square projected pension payable. Black small square normal retirement date. Black small square earliest retirement date at which an unreduced pension may be received. Black small square beneficiary details. The statement also specifies that projections are estimates based on information provided by the sponsor, and the actual terms of the pension plan are outlined in official bylaws. When a group plan member leaves the group, due to a change in employment or retirement, the administrator must provide him with a written statement of his rights within a specified period of time. That statement tells the member black small square the total funds in the member's account as a result of his contributions by the employer, transfers, and additional voluntary contributions. Black small square details about the pension benefits payable to the member. Black small square options for transfer or withdrawal. Black small square deadline for choosing an option. 8.2 Group Retirement and Investment Plans. Group plans provide investment and retirement savings opportunities. These retirement and investment plans are available to many different types of groups, but they are associated foremost with employers. The group members are employees, which may include everyone from the top of the organization through to those at the bottom. A group plan for savings and investment, specifically to assist with retirement savings, is a valuable employment benefit. This is especially true when the employer contributes to a plan on behalf of employees. The employee's pension savings can grow faster and larger thanks to employer contributions. Also, the value of a plan can be received by a spouse in the event of death of the plan owner, or a beneficiary in the absence of a spouse. Another benefit appreciated by employees is the disciplined savings aspect of payroll deductions for plan contributions. Saving by payroll deduction eliminates the temptation to spend take-home pay and save what is left over. Instead, saving is achieved by removing the contribution directly from earnings and then issuing the balance as take-home pay. There is no opportunity to spend money that is not actually received, and withdrawal restrictions on locked-in savings further prevent access to money that is slated for retirement. All members of a group plan enjoy creditor protection of their savings, except when the account is a tax-free savings account, TFSA. Membership in a group pension plan also provides a future benefit to its members through the ability to split income with a spouse. When a group member receives pension income at age 65 or older and receives the pension income tax credit, he can split the pension income with his spouse. Splitting income is an important strategy to reduce income tax. A group plan is customized to the needs and wishes of its sponsor. It chooses the most suitable type of plan and decides on the contributions and benefits according to its financial circumstances. The agent's role during the sales process is to help the sponsor identify available options and create the plan that best meets its objectives, both for the present and for the foreseeable future. When a plan already exists, it should be analyzed for suitability so that a recommendation can reflect current conditions in light of needs. 8.2.1 Existing plan. The agent may find some sponsors without any form of pension or savings plan, and others whose plans no longer meet needs or align with company resources. An existing plan may not have sufficient appeal to attract the talent the company seeks, especially if a competing firm has a better group plan on offer. There may also be good reasons to supplement one plan with another, such as providing a DCPP to all group members plus a DPSP that is based on company profitability for senior executives. The agent must be prepared to analyze both the existing type of plan to provide comparisons against other similar plans, and whether the benefits of the plan continue to be appropriate for its sponsor and members. Some key factors of an existing plan that are analyzed are: black small square suitability of plan to sponsor objective, black small square cost of plan to sponsor, black small square investment options and their suitability for members, black small square rate of member participation. Black small square compliance with regulators' requirements. Black small square support to members by investment provider, such as a website customized for the specific plan, and navigation that makes it easy for members to monitor and change investments. 8.2.2 Plans. Available pension plans are one of two basic types: a single employer plan or a multi-employer pension plan, MEPP. A single employer pension plan is exactly as its name describes, a pension plan for a person who works for one employer. As for the MEPP, it covers employees who work for two or more employers that are not affiliated with each other. Rules differ between jurisdictions for this type of plan. It is most commonly found in unionized work environments, and contributions to an MEPP are made on a fixed contribution basis as determined in collective bargaining. This chapter covers single employer pension plans only. Accordingly, agents who work in communities with a significant unionized workforce will want to acquaint themselves thoroughly with the MEPP rules that apply in that jurisdiction. Some group savings and investing plans, such as DBPPs, are only available through a sponsor. Other plans, such as TFSAs, are available both through sponsors and to individuals who are not enrolled in group plans. Group plans are intended to supplement personal savings, they are not a replacement. Contributions to group plans may reduce RRSP contribution room, but group members should be encouraged to save outside their group plans to build savings for the future and take advantage of tax deferral on savings. A sponsor may implement a single group plan, such as a DCPP, or various group plans. For instance, a DCPP could be combined with a GRRSP or a DPSP to help the employer attract and retain top talent. When a member of a group plan is offered a choice of two or more investment options within the plan, he is enrolled in a form of plan known by its umbrella term, a capital accumulation plan, CAP. Therefore, DBPPs are not CAPs because the member has no investment decisions to make. However, DCPPs, PRPPs, GRRSPs, TFSAs and DPSPs are all capital accumulation plans. When a plan is a CAP, guidelines describe the rights and responsibilities of the plan sponsor, service providers such as the administrator and members. These guidelines are standards intended to ensure that members of a CAP receive the information and assistance they need to make suitable investment decisions. CAP guidelines supplement legal requirements for pension plans. They reflect the expectations of all Canadian pension, insurance and securities regulators. Point 36. As discussed previously regarding their contribution to individual savings, these same plans must be considered from the sponsor's point of view. Black small square defined benefit pension plan, DBPP. Black small square defined contribution pension plan, DCPP. Black Small Square Group Registered Retirement Savings Plan, GRRSP. Black Small Square Deferred Profit Sharing Plan, DPSP. Black Small Square Group Tax-Free Savings Account, TFSA. Black Small Square Pooled Registered Pension Plan, PRPP. Groups may also be offered a non-registered investment account. The following group plans convert registered savings into a pension income stream for group members. Black Small Square Group Life Income Fund, LIF, for savings created in a DCPP. Black Small Square Group Registered Retirement Income Fund, RRIF, for savings created in a GRRSP. It is very important for the agent to understand that a group member receives retirement income when the savings he has accumulated in his group plan are transitioned into a plan that pays a pension. One exception to this is the DBPP, in which the pension is paid by the plan directly. Other plans, such as a DCPP for example, may operate in a similar manner, accumulating savings, but many administrators require their members to take the value of contributions at retirement in a lump sum. To receive a pension and continue tax deferral, those funds are transferred to a LIF or an annuity, both make payments, and in this way, a personal pension is created. If the retiree does not wish to start his pension, he can transfer the lump sum to a LIRA. Table 8.1, provided later in this chapter, assists in understanding plan administrator responsibilities in the course of the transition process. There are other pension plans that an agent may encounter, such as an individual pension plan, IPP, or a supplemental executive retirement plan, SERP. These plans are beyond the scope of this manual. 8.2.2.1 Defined Benefit Pension Plan, DBPP. First introduced in Chapter 1, the DBPP plan is a form of registered pension plan, RPP, that pays a known sum to its members at retirement. The pension income is generally determined by employment income and years of service. Contributions may be made by the sponsor alone, as noted previously, in a non-contributory plan, or by the sponsor and group plan member, a contributory plan. The sponsor is fully responsible for ensuring that funding is adequate to provide the promised pension at retirement. If contributions are insufficient or investment performance has not met expectations, the sponsor must make additional contributions to cover the shortfall. Sometimes, a sponsor is unable to meet its financial commitment to its pension plan. Such a plan is described as underfunded. If the sponsor is insolvent, it cannot be forced to fully fund a plan. In such a case, the pensioner members receive a pension less than promised. Segregated Funds and Annuities Chapter 8 Group Retirement and Investment Plans 231. A pension plan may also have a value, due to contributions and investment returns, greater than its payment obligations. This is called a pension surplus. Sponsors are discouraged from building surpluses both by taxation of the surplus and because a company can be required by regulators or the courts to use a surplus to enhance pension benefits. A DBPP may be terminated by its sponsor or converted to a DCPP. It can also be offered in addition to a DCPP, in what is called a combination or hybrid pension plan. Required contributions are made to the DBPP, but the group member can choose to increase his pension by making voluntary contributions to the DCPP. The group plan member has no investment choices to make when he is enrolled in a DBPP. All investment decisions are made by the sponsor and/or administrator. The sponsor's contributions are a tax-deductible expense and are not a taxable benefit to the plan member. When income begins in retirement, it is paid as a life annuity for the member and his spouse, although the pension received by the spouse is typically a reduced amount. A sponsor may choose to index payments to increases in the cost of living. Doing so affects plan pricing for the sponsor. DBPPs were once the most common form of pension plan. This is no longer the case because some employers have recognized the significant ongoing financial commitment to the corporation created by pension contributions. This expense has been exacerbated by lower pension fund returns as a result of low interest rates coupled with increasing lifespans. The low returns in the funds and pension income that is paid for a longer period of time mean that sponsors are being required to make up shortfalls by special contributions between pension fund value and obligations. Many have taken advantage of their right to switch their DBPP to another form of pension that is less expensive, such as a DCPP. 8.2.2.2 Defined Contribution Pension Plan, DCPP. A DCPP is also known as a Money Purchase Plan, MPP. A DCPP does not create the same financial pressure on its sponsor as a DBPP for the simple reason that no set pension income is promised to members of a DCPP, so the sponsor is not responsible if a shortfall occurs. The member's pension is a result of the amount of contributions made, how long contributions are made, the choice of investments, and the performance of the selected investments. DCPPs are gaining market share over DBPPs because of their reduced financial obligation on the sponsor. Some DBPPs are being converted to DCPPs, and more sponsors are choosing to introduce a DCPP over a DBPP. This trend is likely to continue since many pension plan sponsors do not want to be responsible for pension fund returns, and the fact that plan obligation values increase as lifespans increase, as occurs with DBPPs. DCPP sponsors need not be concerned about investment returns or longevity of members. They set up a plan, make their specified contribution to the plan, and ensure ongoing compliance with regulators. The administrator of a DCPP is responsible for educating all plan members about the details of their plan. Members are provided with investment information to make informed choices of their investments. Providing this information is one of the sponsor's obligations set out in the CAP guidelines. Often, such education is provided by the insurer providing the plan in the form of online tools, a member-only website, mobile apps, newsletters, seminars, and other learning materials. The DCPP sponsor has a minimum financial obligation for each plan member, set out in the plan as a percentage of member income, and plans accordingly. There is no requirement to increase contributions over time. Sponsors have a number of ways to structure a DCPP for its members. They can make participation optional, require members to increase contributions over time, or restrict the number of investment options available. Like the DBPP, sponsor contributions are a tax-deductible expense and are not a taxable benefit to the plan member. The sponsor or administrator chooses investments that will be made available to plan members. Each member is generally responsible for choosing from among those investment options. In certain circumstances, the sponsor or administrator may choose the options for all members. The options may include segregated funds, mutual funds such as target date funds, a form of mutual fund that becomes increasingly conservative as the date on which the funds are needed draws closer, and guaranteed investment accounts. A DCPP can be very beneficial to the member who actively contributes, monitors and manages his investments. He can access available investment options, switch among investments according to his needs and investment performance, and can tailor investment risk to his personal risk tolerance. On the other hand, some plan members may find the choice of investments both complex and confusing. This could lead to delayed decisions or a failure to make decisions. When a decision is not made or cannot be made with confidence, the default investment option may be used. This option, in almost half of DCPPs, is a target date fund. In Alberta, the default option is a balance fund or a portfolio of investments that takes a member's age into account. The sponsor or administrator assists members to make suitable investment decisions, particularly those whose level of education, investment experience, or level of literacy indicates that such help is required. However, the onus for investing is on the group member to achieve their retirement savings goal. 8.2.2.3 Group Life Income Fund, LIF. The DCPP creates a pool of retirement savings for its members. When a group member with a DCPP decides to receive retirement income, he is required to transfer his savings to an account that requires minimum withdrawals. His savings are locked in. This limits his choices to income-paying accounts that accept locked-in funds. One of those choices is a LIF. The LIF can be set up by a person who transfers their pension savings, or it can be provided by the sponsor on a group basis. The group LIF allows continuity for the plan member and lower administration fees than the non-group alternative. LIFs require annual minimum withdrawals and restrict the maximum that can be withdrawn. They are available in all provinces, but sometimes under different names. The percentages for minimum and maximum withdrawals differ between provinces. The sponsor can present the group LIF as an additional advantage of employment to potential employees, a significant benefit for employees intimidated by the prospect of going it alone when retirement arrives and having to decide what to do with their pension savings. 8.2.2. For Group Registered Retirement Savings Plan, GRRSP. GRRSPs are a type of savings plan that permit contributions by both sponsors and members. Anyone familiar with an individual RRSP, available through all financial institutions, finds a GRRSP easy to understand because the two plans are fundamentally the same. Total annual contributions to a group RRSP and an individual RRSP are limited to the individual's RRSP deduction limit for the year, as provided by Canada Revenue Agency, CRA, in the latest Notice of Assessment. One of the differences between an individual RRSP and a GRRSP is that the GRRSP does not generally permit purchase of individual securities, i.e. stocks. However, fees for a GRRSP are usually lower than an individual RRSP. Contributions made by the individual and the sponsor to the GRRSP vest immediately. Therefore, the GRRSP can be expensive for sponsors who have a high rate of staff turnover, since their contributions will have vested and become the property of the employee whenever the employee departs. There is an additional cost to sponsors of GRRSPs because their contributions are considered to be additional salary paid to members. Therefore, they incur payroll charges, such as employment insurance, on their contributions to the group plan. Sponsors who offer a GRRSP make no financial commitment to an eventual pension for members. Like a DCPP, members control their investment activity and contributions. They are responsible for the pension they create. A benefit of the GRRSP is that contributions are made through payroll deduction. This form of contribution typically makes saving easier. Contributions by the employer are taxable as income to the employee and are tax-deductible by the employer. The sponsor of a GRRSP incurs no obligations other than collecting and remitting contributions of plan members. Therefore, this plan may appeal to organizations with limited resources to devote to plan administration. Maturity options are similar for individual and group RRSPs. Savings accumulated in a GRRSP must be transferred into a group or an individual registered retirement income fund, RRIF, or an annuity, the end of the year in which the account owner turns 71 at the latest, to continue tax deferral. 8.2.2.5 Deferred Profit Sharing Plan, DPSP. A DPSP plan is funded by employer contributions only. Contributions to the plan arise from profits. Years with lower profits may see the company suspend contributions. Therefore, a DPSP is most appropriate for those organizations with stable profitability to ensure that contributions to the group plan can be made annually and continually. Employer contributions and fees are tax-deductible for the business and are not a taxable benefit to plan members. Thus, employer contributions are not subject to payroll taxes on federal and provincial government plans. This plan can be used to motivate employee productivity and performance, since contributions are linked to business profitability. Employees receive a tangible benefit from their efforts. As the company profits, so do they. However, employees who own 10% or more of the shares of the company cannot be members of the DPSP, nor can those who are related to the employer or a specified shareholder. One of the benefits of the DPSP is the ability of members to make partial withdrawals at any time. However, a plan sponsor can choose to restrict withdrawals while the member is employed. The sponsor selects the available investment options and members choose from those investments. Once again, like the DCPP and GRRSP, the sponsor does not commit to providing a specified future pension. A DPSP is often used in coordination with a GRRSP to which only members contribute. Employee contributions to the GRRSP are matched by employer contributions to the DPSP. DPSP contributions create a pension adjustment for members and therefore reduce RRSP contribution room. This arrangement is also possible with a DCPP. And a contract issued to the sponsor. Like a GRRSP, the money saved in a DPSP can be transferred to a group or an individual RRIF, or an annuity, to continue tax deferral. 8.2.2.6 Group Registered Retirement Income Fund, RRIF. DCPP, GRRSP, and DPSP members accumulate savings in their accounts. While the DCPP members' funds are locked in, savings in GRRSPs and DPSPs are not. Therefore, these plan members need a registered account to which they can deposit their savings to continue tax deferral when they are ready to begin income. The Group RRIF is a plan that can be set up by the sponsor on the member's behalf in order to transition registered savings into pension income. A Group RRIF accepts transfers directly from the GRRSP or DPSP and offers its members the same features as RIFs available to individuals. It requires a minimum annual withdrawal, but has no maximum amount a member may withdraw. Savings in the GRRSP or DPSP must be rolled into the Group RRIF or individual RRIF no later than the end of the calendar year in which the plan member turns 71. While a RRIF may be set up at any age, it is advisable to set one up only when retirement income is needed, because once a RRIF is set up, mandatory minimum withdrawals must be made every year, with the exception of the first year. Withdrawals from a RRIF are fully taxable as income. The Group RRIF enables sponsors to offer retired employees continuing service, such as information brochures, webinars, and investment seminars, in addition to lower fees than individual RRIF accounts. 8.2.2.7 Group Tax-Free Savings Account, TFSA. The Group TFSA is a newcomer to the group market, but is rapidly gaining in popularity as the public develops a better understanding of the product and the entire concept of a savings account that is tax-free. Tax-free means black small square no tax deductions on contributions. Black small square no need for tax deferral. Black small square no taxation on withdrawals. As with other group plans, black small square sponsors are not obliged to contribute. If they do, contribution is considered additional income. Black small square sponsors are not responsible for providing a specified pension income to group members. Black small square a choice of investments is available. The Group TFSA limits contributions exactly the same way as individual TFSAs. Each taxpayer is allotted an annual contribution limit, the dollar amount of contribution permitted for the year plus any unused contribution room from previous years. That sum is available for his group plan contribution, his individual plan contribution, or a combination of both. In other words, one limit applies to the total of all contributions. The annual limit cannot be exceeded without stiff penalties. An important benefit of the Group TFSA and the individual TFSA is that contribution room is independent of other plans. Therefore, the maximum contribution can be made to a TFSA and an RRSP. Moreover, members benefit generally from lower investment fees as compared to individual plans. Unique to the Group TFSA, as compared with other group plans, is the ability of plan members to make tax-free withdrawals at any time, since contributions are not locked in. This provides flexibility for savings. The PRPP is a relatively new type of group pension savings plan intended for individuals who do not have pension plans available through their employer or for those who are self-employed. They access the plan through licensed PRPP administrators. Administrators include some large life insurance companies. PRPPs are available federally and may be made available in all Canadian provinces. Quebec has adopted an equivalent plan, the Voluntary Retirement Savings Plan, VRSP. Each province is required to enact its own PRPP legislation before the plan can be offered. The PRPP gives smaller companies a pension plan to offer employees without the compliance requirements of other group plans. Plan members benefit from lower administration costs than through individual savings options and the portability of their rights. As members change jobs, the PRPP follows them. Employers may contribute to the plan in addition to employees. Contribution limits are the same as individual RRSPs. They make no commitment to a future pension. Contributions made by the employer are not included in the member's income, and they are not tax deductible for the member. 8.3 Group Plan Investment Options. One of the significant benefits of group plans for members is the lower investing fees members pay in comparison to individual investors. This puts more of their savings to work as investments. When the group investment is a segregated fund, the management expense ratio, MER, is less than what an individual would pay. The lower fee means a larger retirement fund can be built. 8.3.1 Segregated Funds for Groups. Segregated funds may be an option made available to members of pension plans in which the member makes the investment decision. Therefore, they may be offered to members of all plans except those enrolled in a DBPP. 8.3.1.1 Types of funds available. Like the segregated funds available to individual investors, there is an enormous amount of choice. For instance, bond, equity, target, balanced, or specialty funds may all be made available through a group plan. However, the actual segregated funds offered to group members as an investment option in a customized group plan are picked, sometimes with the help of the agent, by the sponsor or administrator. They ensure that group members have a choice between funds that offer capital preservation, growth, or income alone, or in combination, such as a balanced fund would provide. 8.3.1.2 Advantages and disadvantages of group segregated funds. Segregated funds available to group members have a number of distinct characteristics compared to segregated funds available on a personal basis. Unlike segregated funds offered to individual investors, segregated funds for group members have no sales charges. This means savings can be invested in full without a sales load. They also do not charge switch fees for group members. Also, the MER on group-provided segregated funds is generally lower than the MER paid by individual investors. This is due to the primary disadvantage of group segregated funds: they do not offer a maturity or death benefit guarantee nor group plan special rates. The absence of these guarantees increases risk of investment loss for the group member. 8.3.2 Annuities for groups. Annuities for groups are provided for the group itself, for group members, and for retiring group members. 8.3.2.1 Types of annuities available. Sponsors that introduce DBPPs face considerable risk in funding their future pension obligations. They must predict, with the help of actuaries, how much they should set aside in their pension fund for future pension payments. They are concerned with the future rate of return of the pension fund and retirees' longevity. A way to manage that risk is for the sponsor to buy annuities from an insurer in a pension buy-in. An insurer sells annuities to the pension plan sponsor that have guaranteed payout rates that match the sponsor's pension obligation. The insurer then becomes the provider of the pension benefit. Therefore, the insurer takes over the risk of funding the future pension from the sponsor. The benefits promised to retirees are unaffected by the change in provider. This concept of a guaranteed pension also applies to DBPPs for companies that wind up their pension plans because they go out of business. Their pension obligation does not end, even when the company shuts its doors. Their retired group members receive their pensions as expected from the insurer. Members of a GRRSP may be provided with the investment option of an accumulation annuity for their savings. The annuity pays guaranteed interest for a fixed term or a date specified by the investor. Members of a DBPP have a life annuity option when their contribution terminates at retirement. Members in a GRRSP and DPSP have the option of a term annuity or a life annuity. Life annuities may be available as a joint and last survivor annuity and provided with or without a guarantee period. 8.3.2.2 Advantages and disadvantages of group annuities. Annuities provided in the group context provide the same reliability of income as those provided to individuals. They provide security, stability, and peace of mind. Their disadvantages are also the same. There is no flexibility for withdrawals and they cannot be terminated once payments begin. Pension payments are linked to the annuity rate at the time of purchase since payments will not increase if interest rates rise. The annuities therefore carry interest rate risk and inflation risk. 8. For group plan recommendation. The agent must carefully formulate the recommendation for a group plan, just as he would do for an individual. Although he may be working and negotiating with one entity, the sponsor or administrator, he must never lose sight of the group members that this administrator represents. The agent should consider the demographics of members, their general level of skills and expertise, their education, and their degree of employer loyalty, as measured by employee turnover. He needs to understand the objectives when the group is initiating a savings and investment plan for members, and what factors motivate a group with an existing plan who may be considering changes. The agent has a disclosure obligation to his client, the sponsor. He must inform the sponsor of the insurers that he places business with, particularly the firm that is being recommended for the sponsor's policy. The agent should focus on those companies he places business with most often, or most regularly, instead of an exhaustive list of every single company with which he has dealings. In Quebec, an agent who is bound by an exclusive contract with an insurer must disclose this fact to his sponsor customer. It is also necessary for the agent to inform the sponsor if there are financing arrangements in place between an insurer and the agent. This includes whether a loan had been provided by the insurer to the agent, or if there is a commission advance on the sale. These types of arrangements can be viewed as a conflict of interest. Otherwise, the sponsor must be provided with the basic information about how the agent is compensated for the sale, whether by commission or a fee, and if a bonus or travel incentive exists. Specific dollar amounts must be provided if the sponsor requests such details. The agent must also obtain written approval from the sponsor if he receives an increase in compensation after the sale is completed. The agent must be prepared with executive-level presentations of his recommendations since the sponsor may want to question the agent directly about his suggestions, including Black Small Square Plan Specifications, Black Small Square Plan and Investment Recommendations, Black Small Square Pension Credits and Adjustments. One important aspect of plan design is when or under what conditions a group member is entitled to receive a full or partial pension, since this will have a direct bearing on cost for the sponsor. The DBPP may specify a set age, i.e. 65, or it may specify a required number of years of employment, called service, or it may be a combination of age plus qualifying years of service that must be satisfied before the full pension can be paid. The generic formula of age plus service is called a qualifying factor. It is more commonly known by the actual number associated with a plan, such as the 85 factor. However, it does not have to be the number 85, at one time it was known as the 90 factor. It could just as easily be the 75 factor. The employee adds together his age and qualifying years of employment with the sponsor. For instance, an employee who is 55 and has 30 years of employment meets an 85, 55 plus 30 factor. If his pension required the 85 factor to be satisfied in order to qualify for a full pension, then this employee could retire with a full pension at age 55. The plan may also specify a minimum age at which the full pension can be received. If the full factor cannot be satisfied, either because the employee does not have enough years of service or because he is too young, then a partial pension may be paid. The conditions for paying the partial pension will be described in the plan document. Segregated Funds and Annuities Chapter 8 Group Retirement and Investment Plans 242. 8.4.1 Review of Plan Specifications. There are many aspects of group plans that enter into a recommendation and final decision. Key factors and related questions to be taken into consideration are: Funding. Will there be a sponsor funding commitment, and if so, how much? Will contributions be uniform across all group members? When will vesting occur? Costs. What are the costs of each type of plan to the sponsor, including contributions and administration? How will the sponsor determine the age at which a full retirement pension will be paid? Sponsor characteristics. Is the sponsor anticipating significant growth in its workforce? How does this impact the group plan? Group members. Is it more important to retain some members than others? How can the sponsor ensure members participate? Is the sponsor prepared for its commitment to educate members when the plan falls under CAP guidelines? Administration. Who will the administrator be? 8.4.2 Recommendation for a plan and its investments. Developing a recommendation requires the agent to comprehend the composition of the group in order to understand whose needs will be served and whether needs are short-term or long-term. For example, if the group is comprised of members for whom, on average, retirement is very distant, then a plan that provides retirement benefits alone may not be the best fit for that sponsor or its members. When a group is more likely to be motivated by a plan that satisfies more immediate needs, then, for instance, a GRRSP could have much higher appeal since it may be used to assist in accumulating a down payment to purchase a home through the home buyer's plan. The GRRSP may also fund adult education expenses through the Lifelong Learning Plan, LLP. A group TFSA may also appeal because withdrawals are permitted. This flexibility for savings and withdrawals can be very attractive to those with short-term cash requirements. A DPSP can have an immediate effect on employee morale and retention when employees receive deposits to their plan from their employer. Unfortunately, there could be a reverse effect if an employer is unable to make a contribution due to poor profitability, and especially if that condition is repeated consecutively over a number of years. When the administrator and agent have reached certain conclusions and agreed on how to proceed, the agent develops his recommendation for the most suitable type of plan and its investments with the group specialists at the insurer or insurers he represents. The group specialists have expertise in the many aspects of group plan structure and delivery. They also keep informed of changes in legislation and compliance requirements to enable the agent to prepare an accurate and comprehensive recommendation. The sponsor must be prepared for its funding obligation and the effect that this funding has on profitability and shareholder expectations. 8.4.3 Pension credits and adjustments. Pension credits are created in plans every year except in GRRSPs, PRPPs, and Group TFSAs. The pension credit is a measure of the value of the benefit the member earned or accrued during the year. The fiscal year for participation in the pension plans is the calendar year, January 1st to December 31st. However, a plan may be implemented at any point during the year. The method an employer uses to calculate pension credits depends on the type of plan and its provisions. Pension credits for DBPPs, DCPPs, and DPSPs are calculated to determine a member's pension adjustment (PA) for the year. The PA reduces the amount that a member can contribute to an RRSP or a PRPP in the following year. Therefore, the formula for an RRSP or PRPP maximum contribution for a DBPP, DCPP, or DPSP member is contribution based on previous year's earned income to annual maximum pension adjustment equals this year's contribution limit. Example: Ahmed's maximum contribution limit for his RRSP this year is 18% of his previous year's earned income. His earned income for the previous year is $48,000, so his maximum RRSP contribution is $8,640, $48,000 times 18%. His pension adjustment for last year was $3,300 due to the contributions made to his DCPP at work. Therefore, he can contribute $5,340, $8,640 to $3,300 to his RRSP this year. Contribution room to an RRSP and PRPP can be increased by a pension adjustment reversal (PAR). If too much has been taken as a pension adjustment (PA) in a year, for instance, due to the plan member retiring or being terminated during the year, then the PA is recalculated. The difference between the full and the reduced PA is the par. A sponsor may increase benefits of a plan, for instance, by crediting all members with additional years of employment, or by retroactively increasing the benefit formula. This creates a past service pension adjustment, PSPA, for the member. A PSPA reduces RRSP contribution room. The administrator must calculate and report PSPAs. When presenting his recommendation to a plan sponsor, it is important that the agent explain the tax effects of participation in the pension plan with the PA, or the PSPA, if the plan is amended retroactively. 8.5 Group Plan Documents. The group application to the insurer may incorporate suggestions provided by the agent and insurer, or may be the result of a sponsor decision. Many documents must be provided to the pension authority in the jurisdiction in which the plan is being registered by the plan sponsor. Like all forms that the agent has a role in completing, those required to establish a group account must be filled out accurately and submitted in a timely manner to the insurer. The insurer that manages the pension fund for the sponsor provides a regular financial report to the sponsor. The report keeps the sponsor informed of investment income and benefits paid to members. It also provides information on the allocation of funds among investment options and among the members. 8.5.1 Application. A group application is completed first by the administrator on behalf of the group. The application goes through underwriting by the insurer. When the application is deemed acceptable, the contract is then prepared naming the sponsor or the administrator as contract owner or holder. Once the application for the group is approved, group members can apply on their own behalf to join the plan as they become qualified. Members may not enroll until their waiting period has been completed. All members entitled to participate in the group plan by virtue of plan design are accepted. For instance, a plan could be set up so that all employees who have worked for the employer for 6 months are entitled to join the pension plan and are automatically enrolled. 8.5.1.1 Member Forms. Many forms to be completed by members are provided through their group administrator or a website that provides secure member account access. Membership enrollment is the first form for a member to complete. Members will thereafter receive a certificate of membership that details the many aspects of their plan. It includes an identification number. Members have other forms available to meet their needs. At the time of enrollment, they may have forms to name or change a beneficiary or provide a waiver of a joint and last survivor pension or a waiver of a pre-retirement death benefit. A member may also temporarily leave the plan due to disability or maternity leave. A leave of absence form is provided to accommodate a suspension of contributions for reasons specified by the plan. Using this form also means the member does not need to satisfy another waiting period to rejoin the plan after he returns to work. Finally, at retirement, the plan member must provide a notification of intended retirement some months before retirement actually occurs. Income begins at the selected date, if plan requirements for minimum age or age plus service have been met. 8.5.2 Account Transfer. Members with locked-in pension contributions may be required to transfer the value of their pension plan when they no longer work for the plan sponsor, due to retirement or a change in employers. The administrator facilitates transfers according to the instructions of the member. Agents have a client service opportunity with those group members. If the member has or will have the opportunity or obligation to move his pension plan savings, the agent could initiate a discussion about transfer options in preparation for such an event. This conversation can develop from consultation with a prospect or client on any life, health, or investment product. 8.5.2.1 Transfer Options. The sponsor follows the instructions of the plan member when he leaves the plan due to a change in employment or retirement. Options available for transfer depend on the type of plan and whether the plan member wishes to continue savings and its corresponding tax deferral, or to begin receiving income from his savings through withdrawals. Whether income may start partly depends on age at the time of transfer, since withdrawals may not be possible before a specified age. A member from a DBPP who quits can transfer the commuted value of his pension into the pension plan of the new employer and be recognized for years of service under the new plan only if there is an agreement transfer between the two plans. The terms of pension plans are not all the same. The value of one plan may not be equivalent to another plan, and a shortfall can arise. If so, the employee can contribute the sum needed to make up the shortfall in a lump sum within a specified deadline or prorate the amount of transfer. Plans may also differ as to when a pension is available. A group member would likely not want to transfer commuted value from one plan that permitted retirement on a full pension at age 62 to another plan in which the full pension is provided at age 65. The group member of a DCPP may also be offered entirely different investments if he transfers to another pension plan. Even if he finds the new range of options unsuitable, the transfer cannot be undone. Once the funds are switched, they are permanently embedded in the new plan unless the employee once again changes employers. These many conditions must be carefully considered by the group member before a group plan-to-plan transfer is contemplated. A transfer of accumulated funds to a locked-in retirement account, LIRA, or other self-administered plan, eliminates the problems associated with a group plan-to-plan switch. The account owner must be prepared to make investment decisions as he goes it alone. For best results, he should be knowledgeable about the investments available to him and be prepared to monitor his account regularly. He takes on the responsibility of creating the equivalent of the pension income for himself and his spouse. Table 8.1 highlights the responsibility of the plan administrator when a plan member leaves his employer or retires. In either case, the administrator acts according to the employee's instructions. 8.6 Agent Service Requirements. Agents may initiate the process of implementing a group savings and investment plan by identifying potential sponsors and meeting with them to illustrate the advantages of such a plan. Throughout the entire process of group sales and service, the agent facilitates matters, responds to the sponsor's needs, and is the point of contact and source of group information for the insurer while a quote is being developed. 8.6.1 Review Plan with Sponsor. The agent must seek regular input from the sponsor or administrator about the existing plan to retain and enhance the business relationship. Reviewing a recommendation that has been made and not acted upon can be important in building group business. The agent's recommendation may have arrived at an inopportune time for the sponsor, and the sponsor may not have been able to reveal its reasons for inaction. Those reasons may have changed or been eliminated, and the agent may find the sponsor becomes responsive to the idea of a plan in future. 8.6.1.1 Annual Review. An annual review meeting, whether actual or virtual, gives the agent the opportunity to reinforce the value of the plan in meeting the sponsor's objectives. It is also vital to discover if those objectives are changing. It is essential for the agent to stay informed of changes to group savings and investment products, such as the introduction of the Pooled Registered Pension Plan, PRPP, and how those changes could affect the sponsor's plan. He should also maintain a high standard of knowledge about pension trends to discuss impacts with the sponsor. 8.6.1.2 Change in circumstances. Just as important as providing information to a sponsor or administrator is the agent's service role in bringing information about a sponsor back to the insurer. The insurer needs to know about changes to composition of a workforce, both growth and shrinkage, financial circumstances of the sponsor, change in administrator, and other relevant details. A sponsor may choose to wind up or end its pension plan. This requires filing the necessary forms with the provincial pension regulator. The value of the pension plan is held in trust for its members and cannot be accessed by the sponsor. Other conditions under which a plan is wound up include: black small square the sale of all or part of the business to a new owner that does not provide a pension plan. Black small square the business is downsized or closed. Black small square all or most members are no longer employed with the sponsor. Black small square bankruptcy and insolvency of the sponsor. 8.7 Claims by group members. A claim from a group member is initiated to receive the funds in his plan. In order to make a claim, a group member needs to provide the group name and certificate or identification number to the insurer. The appropriate claim form must be completed by the group member to enable the claim to be processed. If a group member dies, the spouse will be called upon for information to enable his claim to the pension proceeds. This type of claim needs to be handled efficiently since the surviving spouse may need to access the proceeds of the plan. As discussed previously, forms may be accessed online or through the administrator. Whenever the agent is involved in the completion of forms, he needs to devote his full attention to detail to ensure accuracy and completeness of information. 8.7.1 Claims for exceptional circumstances. Contributions to some group plans are the basis for locked-in savings. Withdrawals cannot usually be made by the group member when savings are locked in. Their purpose is to fund retirement income. However, there are some exceptions to the locking-in rule that allow the savings to be accessed earlier than they would otherwise be available, or in larger withdrawal amounts. These exceptions vary by province and whether the pension is provided by a federally regulated industry, but fundamentally it is possible to unlock funds when black small square life expectancy of the contributor is shortened. Black small square financial hardship is proven. Black small square the member is no longer a Canadian resident. Black small square the balance of the account is less than a specified sum. Black small square funds are being transferred to a life income fund, LIF, or restricted life income fund, RLIF for federal pensions, and a partial withdrawal is available. Claims being made under any of these circumstances require that the necessary forms be completed by the group plan member. Conclusion. Segregated funds and annuities are important investment products that help individual and group investors save, accumulate wealth, and create retirement income. Their many benefits include their backing by Canadian insurers, which are among the most financially robust financial services companies in the world. This status can give Canadian investors great confidence in both the products and the companies that create the products. The life insurance agent must always ensure that his recommendation of investments is in the client's best interests. To do this, the agent must understand the client and his investment objectives. Regardless of the agent's belief in the strength of the segregated fund or annuity investment, if the investment is not suitable and does not serve the client's needs, objectives, and risk tolerance, then the agent must not pursue his recommendation. However, when the recommendation for a segregated fund or annuity is the right fit for the client, the agent can achieve a great deal of satisfaction in knowing that he has provided a valuable service and product to a client that can help achieve financial objectives. Being in the business of providing investments also means the agent needs to keep on top of new developments in investing, including the introduction of new products, new trends, new analyses, and new requirements for compliance. Reading this manual has been the start of the learning process. It leads to ongoing responsibility and rewards.